Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Well, the president, you know this, right? We've all been talking about it this week, marking 100 days in office. It's a period that has included an avalanche of executive orders that started back on Inauguration Day, his Inauguration Day, letting go of federal workers, hiring some back, scaling back departments, bringing some stuff back, introducing tariffs, then dropping back on some, and just generally taking actions that are potentially reshaping the U.S. government longer term and really how the United States is viewed around the world.
All of it talked about at today's marathon cabinet meeting, I think we could call it, at the White House, including what felt like maybe Elon's farewell.
So, the American people voted for secure borders, safe cities, and sensible spending. And that's what they've gotten. A tremendous amount has been accomplished in the first 100 days. As everyone has said, it's more than has been accomplished in any administration before, ever, period. This portends very well for what will happen for the rest of the administration. I think this could be the greatest administration since the founding of the country.
All right, that, of course, was Elon Musk earlier at the cabinet meeting today in the White House. President Trump, after that, then thanked Elon Musk for his work and said Elon, quote, wants to get back home to his cars. So let's get into it. Break down President Trump in his second term so far, those first 100 days. Bloomberg News national politics reporter Hadriana Lowenkron is in our Washington, D.C. news bureau. Also with us is Beth Fouhy. She's partnered at FGS Global in the company's strategic communications division. She advises clients on messaging and media strategy, which I'm guessing they have a lot of questions at this point. She's here in New York. Hello to both of you. Nice to have you here with Tim and myself. I want to start with you, Hadriana. Is Elon done? What do we know about that? It felt a little jarring.
Well, yes, we had known all along that there was going to be some type of deadline, 130 days, and that was something that we had reporting about from the jump. You know, the president has said we would like to keep him for as long as we can, but we do know that there are some restrictions that do come with being a special government employee, and of course he does have several other businesses, but we are told that his work and his, I guess you could say, legacy, the impact will continue beyond him in the sense that he has a team and that he has been working with different people within the cabinet, and they're hoping to continue with a lot of that cost-cutting work.
Yeah, Beth, come on in here, because we did learn last week, and Tesla shareholders certainly cheered this news, that Elon would be spending more time away from Washington, D.C., but as Hadriana just said, the wheels are in motion when it comes to Doge. How should Americans think about the impact and potential impact moving forward of cutting at the behest of Doge?
Well, I think what you just said is really important, that he is going back to his Tesla world, because shares in Tesla have cratered since Elon Musk has been part of Doge. I think he really has to wonder whether this was worth it for him and frankly, worth it for the president and for the American people. Certainly, there were cuts that were made. I don't disagree that the U.S. government is being remade in a way that probably will never be the same as a result of President Trump's first 100 days, and certainly Elon Musk's efforts at Doge. But the efforts were very scattershot. They were really sort of throwing a grenade into the government rather than surgically cutting and finding the actual evidence of waste and attacking that specifically. He just sort of went after different departments, different agencies, willy-nilly. A lot of lawsuits have resulted, a lot of lawsuits that will and have been successful against some of these cuts. We may even find that Doge is saving no money because there is so much cost to reappointing employees who've unfairly lost their jobs and that the courts have allowed to come back. So it's very unclear that what Elon Musk set out to do and what President Trump asked him to do is actually going to bear the kind of economic windfall that had been predicted. Meanwhile, Elon Musk's own businesses have been really tanking, and he is essentially going back to save them.
You know, Beth, I wonder what's more important, determining whether or not he has had, the president that is, successes or failures in the first 100 days, or whether or not we look at the first 100 days as an indicator of what's to come in the next 3.5 or more than 3.5 years of what's left in the Trump White House?
Well, look, most of the success of a presidential administration really is in the early part of the administration, when the president typically has the highest job approval. Congress is more than willing, especially a Congress like this, a fully Republican, the president's own party, willing to let the president's agenda take precedence. It typically slows down after the early days of the first part of the administration. President Trump, as we've all discussed, has done more than probably any other president in 100 days to make his mark. The question is, how long is that going to last? Much of it's being challenged in court. We've seen poll after poll after poll showing President Trump is losing popularity quickly, that many of the things that he has undertaken in this first 100 days have been met by skepticism and frankly, fear by a lot of Americans. So it's unclear whether he's going to be able to keep this up for much longer.
Oh, that's a really good point. We talked a little bit about political capital earlier this week with Jordan Fabian. About what the president has and he can spend when it comes to Congress. Hadriana, come back in here and just give us, as we do reflect on these first 100 days, give us what you see as some of the successes, some of the wins, but also areas where the president really has not succeeded, some of those losses in the first 100 days.
Absolutely. And as someone, I covered him very closely on the campaign trail. And I think that there are some things that he said he would do that he has headed in that direction of. The border is the first thing that comes to mind. And that was something where even when I was talking to people and voters, it was often ranked above the economy for them, whether they were in Iowa or they were in Phoenix. And so this was something where we can see the border crossings have gone down. On the deportation front, those numbers appeared to have also gone down. And so, has he hit the millions and millions of numbers that he's touted? That has not yet happened, but his administration has pointed to the border crossings as an area of success. And then, as we all know, the tariffs were something that he has said he would do on the campaign trail, and he has done them in a sense that, he has put in some of those tariffs and he's flip-flopped and taken some back. He's offered pauses for some exemptions, and really that's offered a lot of confusion for the markets, as we all know. And more importantly, then the question is, what does that mean going forward? Does that suggest to other industries that they can come in and have meetings and then they can get some of the same reductions that people just recently in the auto industry received? And that was announced yesterday. So we're still navigating exactly what that tariff policy will look like. And that's something, whereas we saw in the latest economic data, that has not worked out well for him. And he has now claimed that to be Biden's fault as opposed to his own. And we had actually done reporting from the jump on the different economic messaging coming from the admin. At what point can he say that the economy was truly his versus his predecessor? And it has seemed that when the data is good, he says it's his. When it's bad, he blames his predecessor.
It's something we just talked about with our own Mike McKee and companies, ordering ahead of expected tariffs. That, as Mike said, that ultimately is President Trump's economy, that buying ahead in anticipation of higher costs. Beth, when you advise your firm's clients on policy and messaging around White House moves and actions, I am curious what's top of mind, and is there an expectation that things will settle down in a bit or not necessarily?
Sure. Well, we advise a lot of different types of clients, and of course, many of them are concerned about the impact of tariffs on their consumers, on their customers. The issue of DEI, of course, is a major factor for a lot of companies in the United States. There was an effort to really push DEI and embrace the ethos of diversity, equity, and inclusion. Just in the last few years. That, of course, has changed under the Trump administration, and many companies are trying to figure out how to embrace the value that they place on diversity while not sort of advertising that this is something that's important to them as a company for fear of retribution from the administration. There's a lot of fear out there generally, I would say. It's a very different atmosphere than we've seen under other presidencies, where you might like the president or not, or approve of his policies or not. The sense of fear of not knowing what's coming and trying to prepare, but not ever 100% sure of what you're preparing for, leaves a lot of consumers, a lot of companies off balance.
Hadriana, on that just advise us a little bit about what you've been reporting on at the White House, to Beth's point about the way, and I think a lot of people would say we kind of see that on display when it comes to cabinet meetings, when we see really the way that these cabinet officials talk so much about the serving at the pleasure of the president.
I mean, it was very complimentary, I would say, just listening to the past marathon of a cabinet meeting. And they definitely are seeking his approval. And, you know, he has been complimentary toward them as well, shouting out a couple of people, and even someone who not in the room, Tom Homan, the kind of appointed border czar, was someone who the president has given praise toward. And so yes, we are seeing that, and a lot of the reporting that I've done has also looked at the different people in industry and those who have been victims of some of the work that has been done. And you can see that as well.
Forgive. We would love to have more time. Hadriana, thank you so much. And of course, Beth Fouhy at FGS Global.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Just a few things we want to get into the tech space. We see super micro shares are plunging. They gave preliminary results that fell well short of analyst estimates. You've got Taiwan Semiconductor beginning construction on a third chip plant in Arizona. And then there's Nvidia, the chip company we all focus on. CEO Jensen Huang expects to compete with China for a long time, doesn't think they are far behind the U.S. when it comes to AI. He spoke to Bloomberg's Anne-Marie Hordern and other reporters on the sidelines of an event in D.C. today.
In order to produce $500 billion worth of AI infrastructure requires enormous amounts of investment from a lot of different partners. And so we've brought on shore many partners to help us do that. And we're going to have to build our own factories in order to do that.
What's your message and conversation going to be like today with the president when it comes to tariffs?
I'm going to count on the fact that the administration has a good plan. And from our perspective, we would like to have policies that support and help accelerate the development of artificial intelligence in this new industry.
Do you think they're going to have an edit of the diffusion rule that was under the Biden administration, basically placing all these different countries in different buckets?
Well, I'm not sure what the new diffusion rule is going to be, but whatever it happens to be, it really has to recognize that the world has changed fundamentally since the previous diffusion rule was released. We need to accelerate the diffusion of American AI technology around the world. And so the policies and the encouragement from the administration, it really needs to be behind that.
All right, that, of course, is Nvidia CEO Jensen Huang. Nvidia shares, by the way, they're down about 20% year to date. They report on May 28th. They are a top supplier to Supermicro. We mentioned that at the top. Semi, the space as a whole, down about 16% year to date. And don't forget that we're going to get a check on this space when Qualcomm reports after the closing bell. That stock is down, Tim, about 4% year to date.
Hey, with our roundup is Bloomberg Intelligence Senior Semiconductor Analyst Kunjan Sobhani from the Bloomberg News Bureau in San Francisco. Kunjan, first up, we just want to start with Nvidia. I know Supermicro is the big stock moving right now, but Jensen Huang's comments on infrastructure investments in the U.S. What is the reality of Nvidia's supply chain today and its efforts to do more in the U.S.?
Well, Nvidia is similar to a lot of its peers and fabless companies are heavily reliant on supply chain outside of the U.S., right? Most of their chips are fabricated or fabbed in TSMC in Taiwan. TSMC is moving into the U.S., and Nvidia, we expect, is going to be one of the key customers using TSMC's U.S. Manufacturing. So a lot of that will come back. But it's not just the chips, right? A lot of the servers, the systems, that's how Nvidia sells its GPU today, the supply chain is still heavily concentrated outside of the US. There's a significant portion in Mexico, which is, I guess, good because it's close by, but significantly concentrated in Asia. So it will take a long time to move all of the supply chain back to the US.
Do you envision a day, Kunjan? This is one White House. We know things can swing every 4 years potentially. Are your expectations, whether it's in 5 years, I don't know how long a build out like this would take, or 7 years, that you will see a lot of semiconductor activity, manufacturing, start to finish happening in the United States?
Well, definitely. Even before this administration came in, just over the last 2 years, given what happened in the COVID pandemic and given the risen uncertainty around geopolitics in general, even with the prior administration's focus on China, we have already seen green shoots and starts of manufacturing brought back to the U.S. The new deals from TSMC accelerates that. We have seen some slowdown from Intel because of the company-specific issues. But if you give me 5 to 7 years, I would definitely say we would have more manufacturing than we have today.
What about when it comes to AI? Because Jensen Huang also said he'd like the Trump administration to change regulations for exporting AI tech from the U.S. to the rest of the world so American businesses can better capitalize on the opportunities in the future. So what does that mean? More chip restrictions? How does that play out in your mind?
Yeah, so I think the article there was focusing on specific on the diffusion rule, and as it stands right now from what the previous administration had laid out, and if we assume no changes, right, for Nvidia, about 60 to 70% of its revenue is sort of safe because it's in the regions which are unrestricted. China, which is about 15%, and we think about 10 to 11% of data center right now, is already from the sanctions that were placed on the H20 and the sanctions that Nvidia has been placed specifically, it's already sort of cut off, right? So the only concern now is that middle tier, which is the regions where you can still ship, where you can bring up data center, but you need licenses and certification. So that's where the concern is. That's where sort of the pie, which is about 15 to 20% for Nvidia, is at risk if these rules don't get changed. So I think that's what they might be pushing more for. Remember, in the US, we are capped by regions where we have enough power. So there are a lot of other power beneficiary regions outside of the US where we could move our data centers and operate from.
Hey, Kunjan, as Carol mentioned, Nvidia, the biggest customer for super microcomputer, shares were down as much as 20% earlier in the session, down about 14% right now. This after the company reported preliminary third quarter results that missed expectations. Interestingly enough, JP Morgan came out and said that they don't think that the magnitude of the revenue miss is representative of any industry-wide demand slowdown. How did you look at this result specifically in the context of the industry? Is it something that the industry needs to be concerned about?
I don't think so. I would in general agree with that point. This seems more of a company-specific issue for them. Again, we only have very limited information, but this suggests more of a timing shift. Basically, what they've said is customers wanting the more latest Nvidia products. But I don't think this should be a signal that there is any kind of demand slowdown from the overall industry or any kind of a weakness in the AI infrastructure CapEx spending.
Hey, one last question before we go. Qualcomm reporting after the closing bell. Is it all about smartphones? What is it? What's the key metric, one or two, that we need to watch out for?
Definitely will be mostly about smartphones. We think the numbers might be safe right now from what we have heard so far from the other companies, especially the first Q China Android numbers, phone sale numbers came in better than feared. So that should help them because this is where Qualcomm is really dominant. Some Apple pull-in also could help them, but the story is all going to be about Apple share loss this year, right? We saw the spring launch for the iPhone SE. Apple already started moving it to its internal modem. They'll launch their next fall flagship product where that trend is expected to continue. We don't know how much volume split will be. So that's going to be the key focus, especially when I rank all the different, AI semis, analog semis, and smartphone semis. Current uncertainty around tariff. Again, the smartphone market much more susceptible to price increases there, a very consumer-focused market. This is the peer group where I think investors are going to play it really cautiously until they get clear signals that there might be no demand destruction.
All right, going to leave it there. Great stuff. Kunjan, thank you so much. I know it's another busy day for you, so thanks for carving some time out for us.
This is the Bloomberg Businessweek Daily Podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
To help us make sense of this in the market moves, we got Gina Martin Adams. She's Chief Equity Strategist at Bloomberg Intelligence. She joins us here in the Bloomberg Interactive Brokers studio. This morning, we got this note. I don't know if you get these, Gina, but Dan Curtis out in London sends these notes to the TV and radio teams with some stats. The S&P 500 as of yesterday climbed for the sixth day. It's up 7.8%. It's the biggest six-day climb since March of 2023. March of 2022. If the S&P 500 had closed, and look, we don't know what's going to happen, but it looks like it won't hit this, at 5611.85 or above, it would be the biggest monthly drop erased ever in that period of time. So my question for you is, today notwithstanding, the buying that we've seen in the last 6 sessions, what explains it?
Oh, it's a good question. I mean, I think that some of it is just a natural recovery after extreme oversold levels that we reached in early April. Some of it is investors' sigh of relief after some risk-off period, reflecting some concerns about whether or not President Trump was going to approach firing the Fed chair, right? We got a little bit of relief out rally after that. Some of it is earnings in the first quarter, at least, appear not to have been as bad as some had anticipated, at least in the market. You've gotten much better than expected first quarter earnings, but not a lot of visibility on the second quarter. And then I'd say some of it is also investors just hopeful that we're going to get some trade resolution. I mean, the natural proclivity of the equity market is to rise. That's something to keep in mind. So the default pace is to go up until it's very obvious that something is wrong, and then it crashes down. It sort of climbs the stairs and goes down on the elevator, basically. So I think that there's a lot of reasons. Definitely, the thing that concerns me the most about this rise is March 2022 was not a great time, unfortunately, right?
Yeah.
And this goes back to something that we've talked about a lot. When stocks are rising very quickly, that's usually a bad sign. Broadly, that only happens during periods of extreme distress. The slow gains of the last 6 days look okay, but the fact that we've accumulated that much strength in such a short period of time is more evidence that we're really still trying to figure out if we're in a bear trend, if we're going to be able to shake off the bear market, if we're going to fall into recession or not. There's just a tremendous amount of uncertainty out there. And March 2022, of course, I don't need to remind everyone, was the beginning of a pretty awful year. So hopefully that's not what we have in store, but nonetheless, there's a tremendous amount of uncertainty out there. So buckle up.
So time to keep investing overseas?
Yeah.
Moving overseas?
Yeah.
Everything overseas?
Yeah, I'll take that cue and run with it, because we did do some more work on valuations again overnight, and published this morning some work on global valuations, where you do still see discounted equities in rest of world, right? The U.S. unfortunately is in this very awkward position where we're still coming off of enormously high valuation multiples. Even though rates are higher, those valuation multiples are built upon a foundation of very robust expectations for continuous U.S. growth. And here we are faced with, maybe we're not going to get that very strong growth going forward. Whereas the rest of the world, equity markets were somewhat depressed in comparison to the U.S. coming into this year. We've started to see some rotation even with that rotation.
Yeah.
The only equity markets of the world that seem expensive are really the U.S., India, and maybe Australia.
Can I ask you something, though? If the United States falls into a recession or something bad, I mean, slow in growth, we've already seen it. I mean, we buy so much stuff from everyone. Is it just the fair assumption that ultimately what these valuations that maybe look attractive overseas will not look so attractive because their businesses and their economies will also fall off?
They will definitely struggle, but I think it's important to keep in mind that over the course of the last 10 years, the U.S. already has been pulling back as the buyer of last resort for the global product, right? This really started with the first Trump administration. For instance, Chinese exports to the United States are half as great as their total export base as they were 10 years ago. So even the Chinese economy is less exposed to the U.S. than it has been in the past. That is the case for a lot of economies around the world. As much as we still import a lot more than we export, there's been this diversification effort underway on account of the first Trump administration, and then especially on account of the pandemic, where global supply chains were diversified somewhat. There's a lot more regionalization happening in global economies where the production is closer to home. It might not be at home, but it's at least closer to home. And that is getting reflected in trade. So there is still definitely exposure, but how much exposure was priced in the equity market is really important to consider. And then also how that exposure has changed over time is important to consider. The other thing that I would say is, coming into a period of economic weakness in the U.S., you always want to focus on beta inside your portfolio. And the U.S. market was the highest beta market coming into 2025. It's still very high beta.
Yeah.
So you've got to worry about the risk that you take on in the U.S., which is really unlike pre-pandemic crisis periods where the U.S. was generally lower beta market.
Interesting.
When stocks were rising, it wasn't always the U.S. just dominating the story. That's the kind of environment that we're coming off of. So an environment where the U.S. is declining, it actually hurts the U.S. most relative to other global equity markets in this small point in time.
You told us that we have to watch earnings. You've been saying that for the last couple of weeks. 50 S&P 500 companies are reporting today. 62 are reporting tomorrow. $6.2 trillion in market cap of earnings today. $9.3 trillion tomorrow. Up to now, what's the message that we've gotten?
The message is very mixed. I don't know if I could paint it in a short brush.
Yeah.
First
you could
quarter
use the word
message,
uncertainty, which is what I hear
know, it's
a lot.
so not fair, but that is the word of the day.
It's the only word we hear.
Or is it earnings and then like throw in something like Google or I don't know, some other names like that makes it different? I don't know.
Yeah. First quarter, better than expected, at least so far.
Okay.
Most of that better than expected is coming on account of healthcare. That's an underreported issue. Yeah. Healthcare was actually much worse in 2024 because of some accounting changes. Growth rates are looking pretty good in 2025. That'll probably continue. Alphabet last week also added the rest of the beat to the index top line, and then we'll see what happens with tech this week. I think it'll be fascinating. The guidance, though, is overwhelmingly the big story of this quarter, in my opinion. We've got record level negative guidance and record level few companies giving us positive guidance, even going back pre-pandemic. So this is worse in terms of guidance.
Wow.
Than
Worse than the GFC?
Even 2020. We don't go that far back in our guidance data, so I can't tell you that much. But it's just extraordinary uncertainty on top of expectations were so high coming into this year that it's just really difficult for companies to satisfy those.
I think it's fascinating what you said about how much like the U.S. has been pulling back on not being kind of the consumer of the world, and it's changed a lot in the last decade. So what's the economy that replaces it? Like if it's the Chinese economy, but should we assume that the Chinese market then comes along with it? Because I think most investors would say not so fast, right? So like can we think about that? Like, who is the economy and market that maybe takes over for the US?
Well, I think we should be thinking about a world that's much less globalized and much more regionalized, frankly.
And same thing for investing?
And from an investment standpoint, that creates a lot of complications for the global most multinational countries of the world, companies of the world. But from just a trade dynamics story, I think what's the big story for me over the last 10 years has been the regionalization of trade, where especially in Asia, you've got what used to be the TPP now operating functionally as a very viable trade, sort of regional trade coalition, if you will, creating economic conditions and changing economic progress in that region, specifically creating a lot of mingling of those economies and codependencies in those economies specifically. Europe has its own. And then we have the US, Mexico, and Canada, which is a different story.
We're going to leave it on that note. Gina, thank you. Gina Martin Adams. This is Bloomberg.
This is the Bloomberg Businessweek Daily Podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
President Xi Jinping's diplomats are fanning out across the world with a clear message for countries cutting deals with Donald Trump. The U.S. is a bully that can't be trusted. Chinese officials are racing to turn foreign governments against the U.S. inside a 90-day window. Trump has granted all nations, except China, to strike trade deals during a tariff reprieve. On tariffs, here's what President Trump said in an interview that aired last night on ABC.
China probably will eat those tariffs, but at 145, they basically can't do much business with the United States. And they were making from us $1 trillion a year. They were ripping us off like nobody's ever ripped us off.
Well, there you have it. President Trump last night, in an interview that I should say aired last night on ABC. Back with us is Jennifer Welch. She's Chief Geo-economics Analyst for Bloomberg Economics. She joins us from our Washington, D.C. bureau. Once those pacts are in place, Treasury Secretary Scott Bessent said he wants U.S. allies to, quote, approach China as a group, giving his side more leverage in negotiations. We did speak to you yesterday about who has leverage in those negotiations. How do you look at the reporting from our team that says that Chinese officials are looking to turn foreign governments against the U.S. inside this 90-day window, Jennifer?
Well, good to be back with you. Yes, Beijing launched this effort pretty much right after Liberation Day to take advantage of that moment to try and curry favor with other countries that were facing reciprocal tariffs from the U.S. and begin to fill their own coalition against D.C. The challenge they're now facing is that most of those reciprocal tariffs have been put on hold, and many countries are far more focused on negotiating deals with the U.S. and see talking to Beijing as sort of an unnecessary risk that could throw a monkey wrench in those talks with Washington. And so I think we're likely to continue to see Beijing rolling out this charm offensive, but I also think they're unlikely to get a lot of traction, at least as long as countries are focused on those trade talks in this 90-day period.
Well, and it's interesting because what about, there are those countries, Jennifer, right, that rely on Beijing and China for raw materials or critical minerals. So it's a little bit complicated, at least for some.
Absolutely. And there are a number of key U.S. trade partners, particularly Latin America, Southeast Asia, the Middle East, that trade far more with China than they do with the U.S. And I think that's where the sticking point in these conversations that Washington says that they're having with trade partners is going to be. How far does the U.S. want these other countries to go in restricting trade with China? If it's focused on key strategic sectors or sectors that those countries are also worried about protecting from Chinese overcapacity, they might be able to make some traction. But Beijing is threatening retaliation against any economies that work with Washington. So it's a charm offensive, but there's a pretty heavy stick that Beijing's wielding as well.
We got some news during the 2 o'clock hour that the U.S. has been proactively reaching out to China through various channels, seeking to negotiate on tariff issues. This came from a post by a Weibo account that's affiliated with state-run China Central Television. How do you, as an expert on the region, as an expert on the country, how do you look at information like that? Like, how should we take in info like that?
Well, this is very intentionally an effort by Beijing to promote this information, right? That didn't just come out kind of happenstance. They're trying to put out this post to sort of contradict the U.S. narrative that we've heard from the administration over the last few days, which is that President Trump says the two sides are talking, and Beijing has been consistently saying, no, we're not. And I think Beijing's trying to project this aura of strength that they aren't running to the U.S. asking for a deal, but it's the reverse. I think the reality is more complex. These two countries are continuing to have daily diplomatic negotiations and conversations. That's just part of being major players that have to talk to each other on a pretty frequent basis. But whether or not they're actually having what we would consider to be serious trade negotiations that are moving us towards a deal, I think that is less likely at this moment in time, just given how far apart the two sides are and the fact that they can't even seem to agree on whether they're having a conversation.
How much, though, Jennifer, is ultimately saving face, maybe on both sides, for both President Xi and President Trump? And I just wonder how much of this dance is to be expected, but that when all is said and done, they're going to come together? Or is that a bad assumption that they will work out something that isn't so onerous?
No, I think you're right. Saving face is a really key driver and factor at the moment in time. Neither side wants to look weak. Neither side wants to look like they're going to blink. That's why both of them are saying the other is definitely going to be the one to call me. We're in the strong position. And I think the challenge is how long are they going to be able to hold that position before the economic pain of these tariffs really starts to bite in, and someone has to be the first to kind of make the first move to pick up the phone. Realistically, I think what's going to happen is that meetings are going to start at a lower level, at more of a working level, and move their way up to a leader level conversation, which is not how President Trump likes to do business. He wants to deal directly with his counterparts. That also tends to be a little bit of a faster way of kind of shortcutting the bureaucratic process and getting to an outcome. So I think you've combined all these factors, and what that suggests is that this is likely to be a prolonged process, in part because it probably will have to start at the bottom and work its way up.
I want to home in on that pain point a little bit, because we talked a little bit about this yesterday with you, but in terms of the pain that these different economies could feel, it does seem like the Chinese economy is better positioned, at least from a consumer perspective, to experience / withstand pain than perhaps the U.S. economy, the U.S. consumer. Is that fair?
I think certainly politically they have a better sort of hand of cards to deal with, right? Beijing has far superior ability to shape public opinion and public sentiment, or at least the voicing of that, than the United States does. They're also not going to be as responsive or sensitive to the sort of feedback at the ballot box that at least many of President Trump's allies in Congress will be next year with the midterms. But I do think that this is likely to deal quite a bit of economic pain to China, and already some of the factory data that we see from April is indicating reduced factory activity, that these tariffs are starting to have a bite, and that's before really we expect the full impact of the tariffs has come into play. That's probably at least a month or two out, as stockpiles and as all kind of the forward trading that a lot of companies were doing in advance of tariffs begins to really hit. And that, I think, really underscores Beijing's interest in this foreign charm offensive. It is existential for them to prevent other countries from blocking off their markets to Chinese goods, because the loss of the U.S. market is going to be significant pain, but it needs those other markets even more to deal with that pain.
What about potential pain on the U.S. front, and pain in terms of perhaps empty shelves or people not being able to order or get what they want when they're used to it?
No, I think you're exactly right. I think first, the line from the administration that these tariffs aren't going to be passed through to U.S. consumers looks extremely unlikely, and some of the initial data is suggesting that's not true. I mean, you look at, for example, Chinese e-commerce giants, and they're quite clearly marking up their prices that U.S. customers would have to face for those goods. And I think second, to your point, there are a lot of goods where the profit margins are so thin that with higher prices coming out of their inputs from China, they're just not going to be able to manufacture them anymore. So good news, bad news story, that maybe that won't have as much of an inflationary impact if you're not paying higher prices because you're just not able to buy anything. But obviously for customers and for manufacturers that rely on those inputs, that is very much a bad news story.
I guess, Jennifer, one of the things that I think about a lot is that in the last 30 years, it's been all about U.S. multinationals, just all multinationals, global multinationals around the world, looking to be involved in the Chinese market. So it's interesting to kind of see where we are in a relatively short time frame of such a contentious relationship between U.S. and China. Having said that, I also think about everybody has a price, right? And I wonder, these nations that China might be reaching out to, the reporting that we are doing, to the surprise of Indian officials, China showed a marked change in approach to a contentious border issue during a meeting last month, according to people familiar. Other signs of a thaw between China and India. Prime Minister Modi plans to go to Beijing this year for the Shanghai Cooperation Organization conference. China offered to buy more from India to help New Delhi reduce the trade deficit. I do wonder, are there things that China can do that really move the needle when it comes to relationships that exist now, and maybe bring China closer to other parts of the world besides the United States?
I think for many countries, they're going to be looking at extracting as much as they can from the U.S. and China, and simultaneously shielding themselves as much as they can from retaliation. I think in India's case, for example, after last week's terrorist attack, rising tensions with Pakistan, which is a close ally of Beijing, right. Now if I'm New Delhi, I'm looking to Beijing to say, okay, what are you going to do to rein in your friend over here? And that might be a real test of how far China is willing to go to secure some of these additional friends beyond the United States.
What do you tell folks who say, all right, where are we in a year, in 2 years, when it comes to global trade, and in particular, the relationship between U.S. and China?
I think the U.S.-China relationship is still likely to be extremely contentious, whether you're looking a year or two from now or whether you're looking 5 years from now. At this point, we're in a structural rivalry, and whether it's President Trump or someone else in the White House, we're likely to see a continuation of these U.S. policies that are taking China on as a strategic rival. And indeed, we saw that continuity from the first President Trump term through the Biden administration and now on to the second Trump administration. I think, though, in terms of the trade relationship, there is a possibility that they'll reach a deal, at least within the next few years. But I think that's going to be very much a long process to get there, and the scope of the deal is really unclear at this point. Is it going to be a phase one redux? Is it going to be a larger structural deal along the lines of what Secretary Bessent and that phase two negotiation that never happened was supposed to achieve? I think the latter is a lot less likely, but maybe something on the former.
Hey, just about 10, 15 seconds. You said it'll be contentious, but will it also be connected, U.S. and China still?
I think these two economies are so interconnected, it's going to be hard to sever all of those links, at least in the short to medium term. But that means that there's a lot more tension that could happen between now and then as both economies try and work towards that de-risking.
All right, great to do a deep dive with you on this, the U.S.-China relationship. Jennifer Welch, she's Chief Geo-economics Analyst for Bloomberg Economics, joining us from our Washington, D.C. bureau.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
The funky music will drive us till the dawn.
On Bloomberg Radio.
All right, TikTok, everybody. Just about 18 minutes to go until we wrap up the trade on this Wednesday. We got some big earnings coming your way. Meta, Microsoft, Qualcomm. There's a whole big drop. eBay, MetLife, KLA Corp. Sorry, I had to look at my list. Robinhood.
You still haven't said it.
Cheesecake Factory.
Thank you.
Yeah, 415. That's coming your way. But really, it's some of the big mega cap tech names that we'll be looking for. Charlie just breaking down the numbers. So we're definitely a lot more bullish than we were at the beginning, but we're still down across the board when it comes to the major equity averages.
Between Tuesday, Wednesday, today, and Thursday, we are hearing from nearly 1/3 of companies in the S&P 500. That would be 156 companies. Today, $6.2 trillion
Can I
in
say,
earnings by
it
market
has just
cap.
been the strangest, I feel like, earnings season. I know we just talked about earnings with Gina Martin Adams, but I feel like we're usually so laser focused. We break them down, but it just feels like everything coming out of Washington in terms of U.S.-China trade, like this will determine so much in terms of the global economy, so much in terms of the U.S. economy and earnings going forward. So I feel like that, to some extent, is really overshadowing the earnings.
Yeah, Gina reminding us that guidance is the big story, a record level of negative guidance and a record few companies giving a positive guidance. Let's see what Brooke May has to say about it. She's managing partner at Evans May Wealth. They've got about $1.3 billion in assets under management. She joins us once again from Indiana. She's back with us. Brooke, I do want to start with the earnings view from you. Again, Gina reminding us that is what to watch. It's been mixed, to say the least. There's a lot of nuance there. How would you characterize or generalize what we've heard from companies thus far?
Mixed. That's probably the best way to describe it. We've seen a broad array of earnings. And to your earlier point, guidance. Guidance is what's moving the market. Look at Snap, for example. Today they're getting penalized because they really weren't able to give guidance. So, as you mentioned, the Mag 7 make up a significant amount of the market cap. And I'm eager to see what Microsoft and Meta have to say today. Earnings expectations, we think Microsoft will be up about 10%. Meta's earnings up about 11%. But again, that guidance is going to be very important.
How many portfolio options are you giving your clients at this point and saying, hey, if the economy goes this way, this is probably how you want to invest. And if we fall into a recession or stagflation, this is how. I'm just curious how you are gaming that out, different scenarios. I know you do probably anyway in terms of risk tolerance, but in this moment in time, how does that kind of factor in?
We're staying mostly invested. We have raised our cash levels somewhat. And we've also made a rotation a few months back into gold as kind of a hedge against more volatility. So we're staying invested, but we're taking more of a cautious approach. We've sold off a few of our names that have higher PEs and are going to be more sensitive to the volatility of a struggling economy. And we've moved into some more defensive names. And so we've been proactive in taking these steps, but really we're trying to err on the side of caution right now.
What are clients asking you when your phone rings, when you look at your inbox? What do they want to know? And I would imagine that this week and last week is less busy than it was at the beginning of the month.
Mm-hmm. Absolutely. They want to know, where are we going next? And, as we all know, the word of the day is uncertainty. And it's very difficult right now to project where the market might end because we don't know what earnings are. And, to forecast where we think the market's going, we look at earnings and we apply a multiple to it. And there we go. We get our year-end price target. So right now it's difficult. We've pulled our year-end price target because there is so much variation in what can happen next. And so we're telling clients, we're setting the expectation, expect volatility, at least for the foreseeable future, the next few months. It takes about 2 to 3 months once tariffs are imposed to actually see them feed through to the economy. And so we don't know what that's going to look like, whether it's going to be inflationary. If so, how bad is it going to get? And so right now, we're just setting the expectation, expect volatility. We're going to stay mostly invested. And if you know right now that you're going to need money in the upcoming year, tell us. We'll raise the cash, set it aside. The market's only about 6% off year to date.
Yeah.
So it's not a bad time to play it safe.
Oh, that's interesting to hear. The reason I ask is because about a week ago, no, it wasn't. It was last Friday. Adriana Lowenkron joined us from San Francisco. She's over at Strategic Wealth Capital. Mm-hmm. And I know this kind of blew you away, Carol. She said, she told us that she actually had clients that were talking about getting out of U.S. assets, and they were really freaked out.
Yeah, she also mentioned somebody who was like looking to move as well. But it was something we really hadn't heard. And I think it's safe to say, Brooke, I get it. We've all been doing this a long time, and you hear, long-term perspective, keep your eye on the ball. What are your long-term objectives? But if things are dramatically changing in terms of, geopolitics, trade, like things could potentially impact U.S. companies in a big way. And that is where a lot of investors have been placing bets because it paid off the last few years, right? Or for a long time. So I just do wonder how you start to think about that potentially.
There's a risk to being out of the market. Like we saw a few weeks back, the market can turn on a dime and it can rally based on a few bits of good news. And you miss that opportunity if you're sitting in cash. And when you look back over the last few years, there's been a lot of potential factors in the market and in the economy that very well could have led to a recession. In fact, there was a lot of banter about the R word and recession coming that never really came to fruition. So we think it's more appropriate to take a defensive stance than it is to reduce our equity exposure in favor of cash or other asset classes, because it can move quickly. Look at the pandemic. The market cratered in really just a few weeks' time, and then rallied. And we've made back what was lost in a relatively short period of time. The good thing is U.S. businesses figure out how to make money in all environments. And while it might take a recalibration, a slowing economy and inflation and additional tariffs, it's definitely going to have an impact. But you don't know at what point things are going to get better. So you do have to stay invested.
Well, okay, so to the opposite of that, Brooke, if you raise cash for clients, if they need it in the next year, where do you keep that cash so it does earn something? And how much do you have on the sidelines right now, just in 30 seconds?
Money market. Right now, a lot of the discount brokers, you can get 4.25% on the money market. So you're earning something. It's not like it's just sitting in cash. And really, in our portfolios right now, we've got about 5% allocation to cash.
Okay.
So there is some, but it's not double digits.
4%, 4.25%, Carol, on the year.
Yeah.
For the year, that's annualized, of course.
I would take that.
Yeah, it beats the year to date, I guess, down 5.73% for the S&P 500.
Still, though, if we go take the 2-year,
When in doubt, zoom out. That's what Carol Massar does.
Right. That's what you do.
Yeah.
And but we shall see. We shall see.
Gina reminding us, upward bias for the equity market.
My husband and I talk about this. It's like, go back 10 years. Where was the market?
Yeah.
Go back 5 years. Where was the market? We got to run. Brooke May, be well, managing partner at Evans May Wealth, about $1.3 billion in assets under management.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.